If the Fed cuts while the ECB holds and the Bank of Japan finally hikes, the S&P 500 does not just wobble, it cracks. And most retail traders are sleepwalking straight into it. Let me show you the 2026 setup nobody is talking about clearly. Right now we have three central banks moving in three different directions for the first time in over a decade. The Fed is leaning dovish because U.S. growth is cooling and credit card delinquencies are rising. The ECB is stuck because European core inflation is sticky and wage growth refuses to die. And the BOJ is the wild card because once Japanese real yields turn positive, trillions of yen carry trade money starts coming home. That last point is the one that should keep S&P 500 bulls awake at night. The yen carry trade has quietly funded global risk assets for years. When USD JPY rolls over hard, you typically see NASDAQ and S&P 500 sell off within days, not weeks. We saw a preview of this in August 2024. The 2026 version could be bigger because positioning is more crowded. So here is the practical forex lesson. Stop trading Euro USD and USD JPY as isolated charts. Start treating them as the early warning system for equities. When Euro USD breaks higher on ECB hawkishness, while USD JPY breaks lower on BOJ hikes, that is your signal that dollar liquidity is tightening in the wrong way for stocks. Now the defensive plays. Gold is the obvious one, but the nuance matters. Gold does not always rally during a crash. It often dips first as margin calls force liquidation, then rips higher as the Fed pivots. So XAU-USD longs need patience and wider stops. The dollar itself is the second defensive play. DXY tends to spike during equity panics because of dollar funding stress, even when the Fed is cutting. That is counterintuitive but historically reliable. The third play, and the one most forex traders miss, is the Swiss franc. USD CHF and Euro CHF often move sharply during risk-off, and the SNB hates a strong franc, which creates explosive intervention setups. Position sizing matters more than direction in this environment. Volatility will be higher than 2025. Cut your normal lot size in half, widen your stops, and let the moves come to you. The traders who survive 2026 will not be the ones who predicted the crash. They will be the ones who managed risk while everyone else got margin called. If you want the full divergence playbook with exact levels I am watching on Euro USD, USD JPY, and gold, comment the word divergence below, and I will pin the breakdown.